that article I talked about the unlikelihood of corporate profits in the United States getting much larger than 6% of GDP. And historically, the band has been between 4 and 6%, and we've been up at 6% recently. So unless you think that profits as a part of the whole country's economic output are going to become a bigger slice of the pie, and bear in mind they can only become a bigger slice of the pie if other slices get diminished to some extent, and you're talking about personal income and items like that. So I think it's perfectly rational and reasonable that in a capitalistic society the corporate profits are something like 6% of GDP. That does not strike me as outlandish in either direction. It attracts massive amounts of capital because returns on equity will be very good if you earn that sort of money. And on the other hand, I think it would be very difficult in a society to get where they'd be 10% or 12% or something of the sort, because it would look like an unfair division of the pie to the populace. So I don't see any reason for corporate profits. They're going to be down in the near future as a percentage of GDP from recently, but then they'll go back up at some point. So I think 10 years from now you'll be looking at a very similar picture. Now, if that's your assumption, and you're already capitalizing those profits at a pretty good multiple, then you have to say that you have to come to the conclusion that the value of American business will grow at a relationship that's not much greater than the growth in GDP. And most of you would estimate that probably to be, maybe 5% a year if you expect a couple percent a year of inflation. So I wouldn't change my thoughts about the profitability of American business over time, and I wouldn't change my thoughts much about the relationship of stock prices over time to those profits. So I would come down very similarly. Now, interestingly enough, some of those same relationships prevailed decades ago, but you were buying stocks that were yielding you perhaps 5% or something like that, so that you were getting 5% in your pocket plus that growth as you went along. And of course now if you buy stocks you get 1.5% if you're the American public before the frictional costs, so that the same rate of growth produces a way smaller aggregate return. I think stocks are a perfectly decent way to make 6 or 7% a year over the next 15 or 20 years. But I think anybody that expects to make 15% per year, or expects their broker or investment advisor to make that kind of money, is living in the dream world. And it's particularly interesting to me that back when the prospects for stocks were far better, I even wrote something about this in the late 70s, pension funds were using investment rate assumptions that were often in the 6% or thereabout range. And now when the prospects are way poor, most pension funds are building into their calculations returns of 9% or better on investments. I don't know how they're going to get 9% or better on investments, but I also know that if they change the investment assumption down, it will change the charge to earnings substantially, and they don't want to do that. So they continue to use investment assumptions, which I think are quite unrealistic. And with companies with a big pension component in their financial situation, and therefore in their income statement, that can be quite significant. It'll be interesting to me to see whether in the next couple of years, where pension funds are experiencing significant shortfalls from their assumptions, how quickly they change the assumptions. And the consulting firms are not pushing them to do that at all. It's very interesting. The consulting firms are telling them what they want to hear, which is hardly news to any of us, but it's what's taking place. Second question about inventory write-offs. That gets into the category entirely of big bath charges, which are the tendencies of management when some bad news is coming along to try and put all the bad news that's happened into a single quarter or a single year, and even to put the bad news that they are worried about happening in the future into that year. And it leads to real deception in accounting. The SEC has tried to get quite tough on that, but my experience has been that managements that want to do it usually can find some ways to do it. And managements frequently are more conscious of what numbers they want to report than they are of what has actually transpired in a given quarter or a given year. Charlie?
Yeah, pension fund accounting is drifting into scandal by making these unreasonable investment assumptions. It's evidently it's just part of the human condition that people extrapolate the recent past. And so since returns from common stocks have been high for quite a long period, they extrapolate that they will continue to be very high into the future. And that creates a lot of reported earnings in terms of pension benefits that aren't available in cash and are likely not to be available at all.
Well, I would say it's a mistake, and I've said it, I think it's a mistake for any company to predict 15% a year growth. But plenty of them do. For one thing, unless the U.S. economy grows at 15% a year, eventually any 15% number catches up with you. It doesn't make sense. Very, very few large companies can compound their earnings at 15%. It isn't going to happen. You can look at the Fortune 500, and if you want to pick 10 names on there that will compound their growth from other than some extraordinarily depressed year. I mean, if they had a year where they just broke even, so the number is practically zero. But if you pick any company on there that currently has record earnings, and you want to pick out 10 of them that over the next 20 years will average 15% or greater, I will bet you that more than half of your list will not make it. So I think it's a mistake, and as I said in the annual report, I think it leads people to stretch on accounting. I think it tends to make them change trade practices, and I'm not singling out Gillette in the least, but I can tell you that if you look at the companies that have done it, you will find plenty of examples of people that have made those sort of mistakes. And I think that in connection with Duracell, I mean, obviously Duracell has not turned out the way that the management of Gillette at the time hoped that it was going to do, and who the investment bankers who came in and made the presentations, those presentations would look pretty silly now. Charlie?
I think that kind of stuff happens all the time. It will continue to happen. It's just built into the system. I see more predictions of future earnings growth at a high rate, not less. I mean, a few people have sort of taken an abstinence pledge, but it's very few. It's what the analysts want to hear.
That's what the investor relations departments want the managements to say. It makes their life easier, but they don't have to be there 5 years from now or 10 years from now doing the same thing. If we predicted 15% from Berkshire, 15% means that, assuming the same multiples, I mean, that means, in 5 years, 200 billion, in 10 years, 400 billion, 15 years, 800 billion, trillion six in 20 years. And the values get to be crazy. And, if you have a business with a market value of 400 or 500 billion, and you've had a few of those not so long ago, just think of what it takes to deliver in the way of future cash at a 15% discount rate to justify that. If you've got a business that's delivering you no cash today and it's selling for $500 billion, to give you 15% on your money, it would have to be giving you $75 billion this year. But if it doesn't give you $75 billion this year, it has to be giving you $86.25 billion next year. And if it doesn't do it next year, it has to be giving you almost $100 billion in the third year. Those numbers are staggering. I mean, the implications involved in certain market valuations really, belong in Gulliver's Travels or something. But people take them very seriously. I mean, people were valuing businesses at $500 billion a year or a year and a half ago. And there's just almost no mathematical calculation you can make that would, if you demanded something like 15% on your money, there's almost no mathematical calculation you could make that could possibly lead you to justify those valuations. Charlie, you have any more? Well, I think the probability of us achieving 15% growth in earnings over an extended period of years is so close to zero, it's not worth calculating. I mean, we'll do our best, and we have a lot of fun doing it. So it's not something where we have to come down and do things that are boring to us or anything of the sort. I mean, our inclination is to very much to do everything we can legitimately to add to Berkshire's earnings and things we can understand. But it can't happen over time. We will have years when we do it, and you're quite correct in pointing out we don't need to do it from the present businesses. We will add things all the time, any more than we needed to do it from the current business back in 1965 with the textile business. I mean, we have to improvise as we go along, and we will. And the businesses we have are good businesses in aggregate. They will do well. They won't do anything like 15% growth per annum, but we will take a good rate of progress from those businesses, and we will superimpose upon that acquisitions which will add to that. But we can't do 15 over a period of time, and nor incidentally do we think any large company in the United States is likely to do. There will be a couple that do it for a long period of time, but to predict which of the Fortune 500 will end up being the one or two or three would be very hard to do, and it won't be more than a couple out of 500. If you take large companies not working from a deflated base year, I think our method is a pretty good one. I mean, I think the idea of having a group of good businesses that throw off cash in aggregate in a big way, that themselves grow, that are run by terrific people, and then adding on to those, sometimes at a slow rate, but every now and then at a good clip, more businesses of the same kind, and not increasing the outstanding shares. I think that's about as good a business model as you can have for a company our size. But what it produces, we'll have to see. Charlie?
I certainly agree that the chances of this 15% per annum progress extrapolated way forward is virtually impossible. I think generally the shareholding class in America should reduce its expectations a lot.
Including the pension funds.
Yeah, including the pension funds, you bet. It's stupid the way people are extrapolating the past. Not slightly stupid, massively stupid.
And this is a message, incidentally, if you think about it. I mean, nobody has any interest in saying this, a financial interest in saying it, whereas people have all kinds of financial interests in saying just the opposite. I mean, you do not get an information flow if you listen to the financial world or read the financial press. You do not get an information flow that is balanced in any way in terms of